is Martin Jones, and this is P2 Corporate Reporting, ACCA P2 Corporate Reporting, with me, Martin Jones, coming to you from lovely, sunny London. It looks very grey in this fake picture behind me. Looks like a typical London day, but it is quite lovely out there at the moment, and I'm glad to be in the air conditioning. Actually, it's so hot. Let me tell you what we're doing together today. We're doing P2 Corporate Reporting, of course, but what exactly we're doing together today. Got a little slide just behind the shard. That's the shard there behind us. So I'll just zip off there to that. Here we go. Let's get the main title up, remind ourselves what we did last time we were together, and then have a look at today's schedule. So here we go. I'm just going to go mini-me. There I am in the corner with the title page just over my shoulder. Just to reiterate what I said to you last time that we were together. Of course, you can email me through the Canvas website. There is an email your tutor button in the website, and you can use that if you find that useful. But I really recommend that you don't, and that you email me directly using mjones@lsbf.org.uk. And I think what I'll do is I'll say a couple of hellos. Welcome to Humayun Punit and Ridwan. Nice to see you again, guys. In fact, Humayun sent me an email direct to my email and prove that it's working very well. So there you go, email direct. Okay, so what did we do last time we were together? Well, we did basic groups. What are we doing now that we're together again? We're doing complex groups. But within complex groups, actually, we're going to finish off the complex part of basic groups. Sounds slightly nonsensical, but once you've done this component of learning with me, you'll certainly understand what I'm talking about here. So let's not dilly-dally around. Let's just get going. There's the class notes. Just check you got the right ones. Corporate reporting from September, December 2017, of course. And we skip down to page, I don't know, I'm guessing, maybe 20. Just guess. Did I go too far? Hebrides. Yes, I went a little bit too far. Oh, way too far. Because we want the pop stars. The subject matter is changes in ownership, and it starts quite gentle with Lady Gaga and Adam Ant, but it really, builds up to some fairly fancy stuff once we get into the other two pop stars. So I think what I'll do is I'll just go for it. I'll just start. I can over-introduce this, oversell it, and then find myself running out of time and space later. So let's just get into it. So the subject matter is changes in ownership. Sure it is. And there are 4 of these. That's why there are 4 pop stars. That's why there are 4 little baby examples. There are 4. And the first 2 are the most common, and you'll be pleased to hear they're the easiest as well. The first 2 are a pair. They are acquisitions and disposals. And these occur when you get control or lose control. So the name of the event when you get control of a subsidiary is called an acquisition, and the name of the event that occurs when you lose control of a subsidiary is called a disposal. Now, it just occurred to me that I haven't done my usual test, so I'll do my usual test. Can you tell me what word I have highlighted in horrible, violent pink? What word have I highlighted there? Total random word, by the way. It's not got any particular meaning. Excellent. Good and quick as well. So the internet's working well today. That's good. And I noticed Greg's got his name up there as well. Welcome, Greg. I'll get rid of that because that was just a random word. That was just a test. So back in there again. These two have a large chunk of intuition about them, especially the first one, which is, you'll be unsurprised to hear, an acquisition. So Lady Gaga, we'll just go for it. Lady Gaga is highly intuitive, so we're just going to go for it. Now, the question Lady Gaga asks for goodwill, as you can see, and it is so intuitive that we're just going to go straight for goodwill. Excuse me. So goodwill, you'll remember when we were last time together, is three things added together. And that gives you this thing called goodwill. Excuse me. And let's go for it, guys. Let's go for it. Here we go. So at the year start, Lady acquired a 10% interest in Gaga at a cost of 25 million. At the year end, Lady acquired a further 45% interest in Gaga at a cost of 120 and obtained control. The fair value of the initial 10% interest at this time was 27, and the fair value of the NCI was 110. The fair value of the identifiable net assets was 150. You can see that, even though that little scenario over my shoulder is quite short, it's actually got quite a lot of financial data in it, has it not? So what I'll do is I will take you away from the financial data and point out the real key information here, which is the ownership percentages. The ownership percentages in these questions can be deemed to be representative of control of the relationship. It's a bit of a techie sentence. But another way of saying this is that when you've got these stories happening, what seems to be going on, it is what's going on. So the 10% is bought first, and then the 45% is bought on top of that. And of course, the 45% itself on its own is insufficient for control. But on top of the 10%, it gives 55%. That would give us 55% of the votes, and therefore the power to sack the subsidiary directors. So there is an acquisition here, but there's just one acquisition. And the one acquisition takes place at the year end. The other thing at the year start is just a share purchase. So the acquisition happens at the year end, which means this schedule over my shoulder for goodwill occurs at the year end. So the schedule is at the year end. So all we need is a bunch of data representing the fair values at the year end. Well, now that we've got that concept, we can probably pick up that most of the information is, excuse me, just let me go off camera because it's never nice watching someone blow their nose on camera. So just let me just disappear into a corner for a second. Oh, yeah. Wonder how newsreaders do it. Wonder how they blow their nose. Are they on camera for such a short time that they can blow their nose? This must have happened that suddenly they get an itchy nose. So we're going to pick up the financial data, and most of it is just copying. So the fair value of net assets was 150. You can see I'm working backwards. I think it works easiest with this question. It's 150. The fair value of NCI was 110. Fair value of NCI was 110. But wait a second, what is the NCI? Oh yeah, of course. When we get control, we have 55%, and therefore the NCI must be 45%. Oh wait, that means the controlling interest is 55%. And it is, but I think you'll find it easiest in the exam if you do a little bit of this. Can I just check those numbers? Because I think I was going to... Yeah. The reason I'm just a bit surprised about that is I had it in mind to change these numbers slightly, but I clearly didn't change them. They look exactly the same as they did last time. This block of ownership is very clearly 55%, but it really helps if you break the 55% up because, well, there are two numbers related to the 55%. There's the number for the 45% and the number for the 10%. And you can't get the 45% wrong because there's only one figure available for us to copy. The 45% was acquired at a cost of 120, so that cost was the fair value at that point. But that's the thing, you see. When the examiner says fair value, which figure do you think you pick? The fair value or the cost? When the schedule says fair value, which figure should we use? The fair value or the cost? We should use the fair value, obviously. So the one where we have the possibility of getting this wrong is the 10%, because there's two figures available for the 10%. The 10% has a cost of 25 and the 10% has a fair value of 27. And clearly when we want the fair value, we want the fair value. I think it's fairly obvious when we want the fair value, we want the fair value. So that's the 27. That's pretty much the only figure that you could get wrong, but as long as you concentrate on the fact that we want fair value, I don't think really it's that difficult. So yeah, what we want is fair value. And what we're saying is that the fair value of the 55% when we get control is 147, that's what we're saying. So the fair value of the 55% at the point that we get control is 147. And then we add down and that's the goodwill. Quite natural, isn't it? So I was a bit rubbish with my brain calculator, wasn't I, last week? But I think that's 107. Last time we were together, I kept on making mistakes, didn't I? So keep watching me. I might make some today. Yep, cool. Great. Thank you, Punit. Now, you can see that the question doesn't ask for this, but let's have a look at this. What is the gain made on the 2? What 2? What is the relevance of the 25? What 25? This one. The gain of 2 million, and that's the 25 up to the 27. The difference between 27 and 25 goes to P&L. And it's quite easy to see these figures in this particular case, but actually in the examination, although that 1 mark is quite easy to see once it's been pointed out, it's quite hard to remember to do that. When you're working at speed in an examination, it can be hard to pick up little details like that. But there you go. There is actually another mark for picking up the gain of 2 in a real exam question. So that was very intuitive. Didn't seem to be very difficult. But actually there was some conceptual backdrop to this, and we have to have it in the context of the other question. So we'll bring it into play now, and you'll see what it is that IFRS 3 is doing. The IFRS that we're studying at the moment is IFRS 3, IFRS 10, depending on your mood. IFRS 3 and 10. Now IFRS 3 and IFRS 10, the IFRS numbers are irrelevant, but the concept is definitely relevant. The standard requires that we go through zero ownership when there is a change in relationship. Wow. That's techie, isn't it? What on earth is that talking about? Well, that is very techie, and therefore we'd be well advised to take it slowly. The first component that we'll look at is the concept of a change in relationship. That's the first thing that we'll look at. So we'll look at relationships, which we have done already, but we'll reinforce the idea of these relationships now. There are three. There is, of course, control, influence, and neither. And of course, these gives rise to a sub, an associate, and an investment. And as it happens, this one is a change in relationship from neither control nor influence, from neither up to control. The question we've just done, Lady Gaga jumps up like this. What colour should Lady Gaga be? She should be bright pink, shouldn't she? So that's what question Lady Gaga is doing. But what's this about going through zero ownership? What's that all about? Let's have a look at the application of this concept to the question Lady Gaga. Application to Lady Gaga. So, for question Lady Gaga, we pretend that, which way are they going? So it's 10% down to 0, back up to 55. We pretend that we sold the 10% investment and, and bought a 55% sub. Which is not true. So at the year end, what actually happens is that we go up from 10% to 55% by purchasing 45%. What actually happens is we've got an underlying 10%, we buy 45% on top, and we go up from 10% up to 55. But the law requires that we pretend we sold the 10% and then went up, which is not true. but it is the law that we must pretend that we went through 0. So we must pretend that we sold the 10%, went down to 0, and then went back up to a 55% sub by buying a 55% sub. And you can actually see the application of that concept in what you've just done here. It doesn't particularly jump out, I have to say. It really jumps out in the next one, but not so much in this one, but it does kind of jump out. So if you had have sold the 10% at the year end, what would you have got? 27. And what would have been the cost? 25. And what would have been the profit? 2. And where would you put it? The P&L. So the IFRS really is treating this as if you had sold the 10% and bought back a 55% subsidiary. That is the basis of the IFRS. But you can see you didn't really need the concept to be able to answer Lady Gaga. You didn't really need the concept to answer Lady Gaga, but you do for Adam Ant. So let's apply this concept to Adam Ant now. So going now to Adam Ant. There we go. Now we'll do the same kind of thing as we did just a moment ago with Lady Gaga. We'll focus on the ownership percentages, the voting percentages. We'll focus on those. At the year start, Adam acquired 70%. And then at the year end, Adam sells 25%. Now what Adam actually sells is 25%, but it's not relevant what Adam actually sells. What is relevant is whether we keep or lose control. When we drop from 70% down by 25%, we drop down to 45%. And 45% of the votes is insufficient to keep control. So we do end up with influence, but what's more important is we lose control. And the name of the event where we lose control is a disposal. And on a disposal, you calculate the profit on disposal, and that's the requirement of the question. But how are we going to treat this? Well, the IFRS requires that we go through 0. So what we actually sold is 25%. But what we're going to pretend we sold is we're going to pretend we sold the 20... can I try that again? We're going to pretend we sold the 70% subsidiary and bought back a 45% associate. We're going to pretend we sold a 70% sub and bought a 45% associate. And you just cannot do this question unless you know that concept. But we do know the concept, so that's okay. So let's go for it, guys. And you can see quite clearly that these two applications, although they're going in opposite directions, have the same underlying logic. They're both going through 0. First of all, you pretend you sold, and then you pretend you bought. So if you're going up, then you go down, then up, and if you're going down, then you go down, then up. They do exactly the same thing, so that's great. So the logic of these two is absolutely completely consistent. It's just great. It's really great. And not that old, actually. These ideas are 2008 that was developed, which doesn't seem that long ago to me. It just probably seems quite a long time ago to you guys, but yeah, really good stuff. So there we go. Let's go and do the question now. So, question. Adamant. So adamant is a little more tricky. So we will revert to our usual process of going net assets, goodwill, and then add across. So net assets first. A little bit strange the way that this is presented, but let's just go with it. At the year start, Adam acquired 70% of Ant for 460. Ant had identifiable net assets with fair value 300 at acquisition, and fair value of the NCI was 200 at that point. At the year end, Adam sells 25% of Ant for 250 and loses control, but retains influence through its remaining 45% ownership. The fair value of the associate retained is measured at 410. At the year end, Ant had identifiable net assets of 330, and the growth of 30 had been reported through the income statement. We could have worked out the growth for ourselves. It is given, but we could have worked out the growth for ourselves as follows. So the net assets are given at both points. They were 300, they grew to 330, and the growth was 30. Nice. Then we whack that into a goodwill schedule. The goodwill comes into existence at the year start and then gets derecognised in a disposal at the year end. So we have control of this customer base for just 12 months. So when the acquisition took place, we were talking an ownership split like that. The net assets we've picked up already. It was 300. And the other two we can pick up quite quickly. So it's 460 and 200. So 360. Have I done that right? Yep, that looks good. And then we lose control of that goodwill at the year end in a process known as a disposal. And the disposal, the essential point in the disposal is right at the top here. It's the actual sale proceeds are compared to the deemed sale proceeds to give us what we would have got if we had actually sold the whole 70%. Of course, the actual sale proceeds are related to the 25% that we did sell, so that's quite easy. But the deemed sale proceeds are fake. Deemed really just means fake. So the fake sale proceeds are going to be harder to generate because we're going to have to work out what we would have got if we'd sold the block of shares we didn't sell, which is obviously a bit more tricky. Now, I think I'll stop there for a second and actually pick up these numbers from the scenario. Once you know the trick, it's not that difficult, but yeah, getting the trick, it's worth spending a moment. Let's spend a moment. So clearly the 25% was sold for 250, so that's the fair value of 25%. But the 45% was not sold. But the 45% apparently had a fair value at that point of 410. So I guess if we'd sold the 45%, we got 410 or something like that. So 250, 410. 250, 410. And then we completely lose control of the non-controlling interest. We completely lose control of the net assets, and we completely lose control of the NCI. Oh, sorry. Ha! No, you don't have NCI twice. You completely lose control of the subsidiary, and the subsidiary is just a business, and a business is made up of people and things. So you lose control of the things, you lose control of the people, you lose control of the people, lose control of the things, but you also lose control over the NCI as well, so you need to de-recognise that. So goodwill first, we've actually got this figure already. We drop that one in there, so that's 360. We lose control of that. The year-end figure for the net assets, 330, and then we need the NCI. NCI is always measured by a roll forward. So we just roll this forward, we roll the NCI forward, and once you practice it a few times, it's like falling off a log. 200 plus 30% of 30, 200 plus 30% of 30. So that's 200 plus 30% of 30 gives us 209. And then we add down for the profit, which then goes to the P&L report. Oh, by the way, what we're saying is that if we had sold all 70%, we'd have got 660. If we'd sold all 70%, we'd have got 660. And you really must pretend that you sold the whole lot. It's the law. So 660 plus 209 minus 690. Gives us 179. How's that? It's all right, isn't it? I'll just let you recalculate that. Bennett looks like he's got his pluses and minuses a bit mixed up. And in the meantime, I'm going to grab myself some water because I feel like I'm struggling a little bit today. Back in a sec. Thank you for your patience, guys. I seem to be struggling a bit with my nose running and feeling dehydrated. That water, I'm sure, will help me make it to the break, which is only in a couple of minutes' time anyway. So there you go. If it was, you know, those are the most commonly examined. There's 4 pop stars. There's Lady Gaga and there's Adamant. And then there's the other 2, Iggy Pop and Busta Rhymes. And Iggy Pop and Busta Rhymes, they do come up fairly frequently, but you're talking probably once or twice a year. So not in every sitting, you know, probably twice a year. Whereas acquisitions and disposals are almost, you know, almost guaranteed. They're almost in every single examination, to be honest with you. So it's a good job. It's a good job, really, because the first 2 are definitely easy. You're probably feeling quite relaxed now. But the next component of changes in ownership is a jump up. And it's what happens if there is a change in ownership, but the entity, the parent, retains control over the subsidiary. And like with the other one, there's a danger I'm going to do too much talking and not enough showing. So I will show you what I mean by zipping off to Iggy Pop. Now just check out Iggy Pop. Can you see that there are actually 2 of them? Basically it's Iggy Pop example 1 and Iggy Pop example 2. So each of these, they're separate questions, but Iggy Pop is quite tricky, you know. So rather than just do it once, we're going to do a variation on the question for a second question. So it's like example 1, example 2. But we're going to do example 1 first. So Iggy Pop at the top. So I'll start highlighting now. Percentages, of course. At the year start, Iggy acquired 70% of Pop for 350. At the year end, Iggy acquired a further 10% of Pop for 55. Now, when this second transaction took place, is there actually an acquisition? Do we get more control with our 10%? Well, have a think about sacked directors. If we'd sacked the subsidiary directors with 70%, would they be less sacked than if we sacked them with 80%? If we sacked them with 80%, would they be more sacked than if we sacked them with 70%? Of course not. So this doesn't make any difference to the control, but what is changing is the ownership. So what we're doing is we're retaining control, but we're changing the ownership structure. Now, there's only so much, you know, subsidiary to go around. Pop, it is. There's only so much pop to go around. So if our ownership is going up, our ownership is going up, then their ownership is going down. Now, who are those guys? Those guys are the NCI. So if the NCI is going down and the CI, the controlling interest, is going up, then they are transferring ownership to us. And that's the name of the subject. It's called transfer of ownership, or sometimes called transfers for short. So this occurs if there is a change in ownership but no change in control. Like I said, they're pretty common, but not in absolutely every exam. Now, annoyingly, the examiner is inconsistent with his model for accommodating these two. The reason that there are 2 questions, the reason that there are kind of 2 sub-subjects within this wider subject is because there's 2 different transfer directions. Using the simple language of us and them, or indeed the more complex language of controlling interest and non-controlling interest, you can quite clearly see that there's two different transfer directions. There's this one here, which is exemplified by question Iggy Pop. And you haven't looked at it yet, but there's another one down at the bottom going this way, and that's exemplified by question Buster Rhymes. And you're not going to find Buster Rhymes difficult, but you are going to find it different because the examiner has a different model at the top compared to the bottom. It's most annoying. At the top, he uses a proportion model, whereas at the bottom, he uses a percentage model. And this inconsistency doesn't really make sense, but it is what the examiner does, so we'll just do what he does. So I'm not going to do the second one yet, but let me do the first one first. So going back to the actual numbers in Iggy Pop, now you can see that we're going up from 70 to 80%, 10% is coming into our pocket from the NCI. Now look at this from the NCI point of view now. The NCI used to have 30%, but their 30% went down from 30% to 20% because they gave us 10% of their 30%. Just check that again. From our point of view, we're going up from 70 to 80. But from their point of view, they're going down from 30 to 20, which is a reduction of 10%. But what is the proportion? It's 10% of the former 30%. And that proportion is a third. So if we measure the NCI, take a third of the NCI, and leave them with 2/3, then we will have measured this process. If we measure the NCI, take a third for ourselves and leave them with 2/3, then we've nailed this question. That's the basis. All right, let's do it. So question Iggy Pop. At the year start, Iggy acquired 70% of Pop for $350. The fair value of the identifiable net assets of Pop at the point of acquisition was $110. The fair value of the NCI was $138. Cute. And we're being required to do goodwill. So let's just do goodwill. Oops. Well, I don't remember the detail, don't remember the financial data, but I do remember the ownership split at acquisition at the year start. So now we just drop in the rest of the data, the financial data. So we've got 350. Net assets 110. Fair value of NCI is 138. And then add down, it's 28,378. And then we do the transfer. So to do the transfer, what we do is we measure the NCI at the year end in the usual way.
So NCI is measured in the usual way. There's no difference in the measurement process. The NCI is 138 plus 30% of the growth. Oh, I don't have that figure yet. Oh, okay. So it's 138 plus 30% of the growth, which I don't have yet. But presumably it's in the question. So let's go and have a look. So at the year end, ACCA acquires a further 10% of POP for 55. POP has made profits and grown by 20 over the year. Lovely. So there's the growth. So 20. So that's 6. That's 144. Yep, that looks good. And then I'm going to take a third of that in a transfer. I'm going to take 10% of the 30% of the 144, which gives me 48, I guess, to leave 96. Is that right? Certainly looks right, doesn't it? So 144 divided by 3, yep, 48, to leave them with 2/3. Oh, sorry, I should say NCI before. So it's at the year end, but in the morning, and then NCI after. So it's at the year end, but in the afternoon. And what's happening here is that chunk of ownership is coming out of the NCI and going into the CI. Lovely, looking good. What? Oh no! Drive on the left, crash on the right. Oh no, it's double entry. And what we're going to do is we're going to make the NCI go down. You can see the NCI is going down. Now the NCI is on the bottom of the balance sheet, and the whole of the bottom of the balance sheet can be called generically creditors. So we want the creditor of NCI to go down, so we debit the NCI with 48 to make it go down from 144 down to 96. And then we credit the CI. But what's the CI? I never heard of that before. The CI is the SC, the RE, and the OCE. Huh? What? The SC, the RE, and the OCE. I recognise some of those. SC, share capital, RE, retained earnings, and OCE, this is the one, OCE. It'll be the first time that you'll have heard of this, but actually in the examination you won't be writing it full anyway, you'll be abbreviating it. But anyway, here's the full name. It's other components of equity, other rubbish basically. No, I can't get it in, so I'm going to give myself a bit more space for the journal. There's no reason to squeeze here. OCE, the other components of equity. And there you go. What that does is it makes the CI go up and makes the NCI go down. There's a movement from one to another, a movement out of the NCI and into the OCE. Wait a second, wasn't there something else going on in the question? At the year end, ACCA acquires a further 10... Wait a minute! Of POP for 55. That's a cash flow. We can't go around ignoring that. Nope, you're right, we can't. And that's called consideration. And when considering the consideration, the International Accounting Standards Board decided to dictate a rule. This rule is just a rule, and we do it because it's the rule. And the rule says consideration goes to OCE. Like everything I say, there's an element of simplification there, but that's essentially what it says. Oh, very good. Some nice double entry up there on the chat. So let's do the consideration journal. So the consideration journal, what the heck was going on? I've forgotten already. Is the money coming in? Is it going out? At the year end, Iggy acquires a further 10% of pop for 55. Yep, I'm going to buy myself another coffee. I'm looking forward to it already. And when I buy things, when you acquire things, cash flows out. That's how cash flows. So cash flow out would be credit the bank with, can you believe it? I've forgotten the number already. 55. And the debit goes to OCA because that's the law. Wait a second. That's the second reference to OCE. There's a reference to OCE there and there. Oh, but wait a minute. One of them's a credit, the other one's a debit. They've got opposite signs. Hang on a second, they don't quite cancel out. Go and have a look at the requirement. Go and have a look at the requirement. Can you see this reference to the effect on controlling interest? That effect on the controlling interest is valued by your examiner at 4 marks. Woo, 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 woo. And the 4 marks is for the 7. Effect on CI. The transfers coming into the CI. Uh, 48. But the consideration is going out. Giving a sausage 7, not just 7, but a decrease of 7. So you have a decrease to OCE. Your examiner's only consistency is his inconsistency. Usually he values that at 1, 2, 3, 4 marks, which is a lot, isn't it? On one occasion, he gave it 5. On another occasion, he's even given it more. And also on other occasions, he's given it 2. Or most recently 3. So if I was going to guess, probably 3 marks next time it comes up. But you never know. 3, 4, somewhere around about there. So, but hang on a moment. If the 3 marks are for the -7, why are we doing the journals? Good question. The journals are not required by the requirement. We don't need them. Exactly. So the purpose of having the second question, which I've called Iggy Pop Parallel Universe, this, example 2, this parallel universe example, is there deliberately in order to allow us to basically do the same question again with slightly different numbers, but see if we can solidify our knowledge, but also be a little quicker and a little bit more efficient by pulling out the journals and not doing the journals. So I recommend you don't do the journals. So yeah, let's take a break, and when we come back, we will do question Iggy Pop Parallel Universe, but we will pull out the journals. We will do no journals. Just a very short break, just long enough for me to get myself some more water and freshen myself up. So a very short break.